All right, welcome back to the channel. So today I wanted to revisit Target, and I made a video previously on Target, and I'll link to it somewhere around here. But it's come down a bit more, and it's starting to pique my interest. And Target has been one that I have been interested in over the last couple of years. So I wanted to do a little revisit to Target and see if anything has changed. All right, and looking at the 5-year chart, we can see it's coming down quite a bit. Previous highs was about 260, and we're sitting at 127 right now. I did take a small starter position in this right around 130, just to keep it on my radar. And initially, I believe in the last video, I had my base and my bearish buy points at around, I want to say like 112 and 92 or so. And you can go back and look at that video and see what I had back then. And we'll plug in the numbers and maybe change some assumptions a little bit, revisit it and see what we get now. Now, similarly to other retail stocks, Target has cited increase in retail shrink or theft recently, and it's kind of been more the same of, consumers kind of tightening down. A lot of spend going towards discretionary items, not discretionary, but a lot of spend going towards essential items and less towards discretionary, which is a little bit worrisome for discretionary spend because Target is highly discretionary, I would say. Even the price point that Target's goods are at are usually a bit higher, so Target is not exactly the place that you go to save money. It's usually the place you go to, walk around and look at stuff, and that's typically, what my wife likes to do. So if we continue to get a consumer that's going more and more towards just staples and essential spend, Target could be hit pretty bad in the upcoming quarters if we kind of continue to see that consumer spend shift towards those staples. And then additionally, there has been some drama going on around Target, so that's been in the news. I'll just let you read the titles right there. And it's something you got to assess with this one. Is it going to really make that big of a difference, or is it just going to be short-term noise? I believe their last earnings, they did beat on bottom and top line, but they kind of missed, the guidance, I believe, was revised downwards. And then on top of that, they have also had some downgrades from different analysts. So it's been kind of getting hit from all sides of Target recently. And you know what? I'm gonna have to take that back. They actually they are maintaining their full year guidance, so they did not downgrade their guidance. It looks like they're maintaining their full year guidance based on the expected benefit from efficiency and cost savings efforts. So that is kind of interesting. I thought they revised their guidance downwards. So maintaining guidance that's kind of interesting. So I'm starting to think of, this is just a beatdown stock from a lot of drama that has been going on. Now, you got to make your own assessment of if that drama is valid and is going to actually affect them long term. It could. But everybody's going to have to make their own mind up about that. Now for Q2, it looks like they are guiding for about 130 to 170 in EPS, and they are expecting to see softening sales and from the first quarter continue into the second quarter, so they've got a pretty wide range, I believe. For the full year, they're maintaining the prior guidance, and that is EPS of 775 to 875. Now, if we look at Target's historical EPS, it looks like in 2022 is about 598. 2021 was a really strong year at 14, and then we had $8 in 2020, I believe. Yeah, 2019 was about 636. So like I said in the previous video, I was kind of like looking for Target to normalize, and I think we're pretty much in that normalization state where we had a really good boom through kind of COVID, and then we saw a really tight pullback, and they did not exactly manage their inventory well either. So we kind of saw that increase in earnings pretty drastic. You can see EBIT and net income right here from 2018 to 2021 increased drastically, and then we had a nice pullback in 2022, and it looks like we're probably gonna potentially increase going into 2023. So we're kind of seeing this ebb and flow and normalization over the last couple of years. Now, the more difficult thing is gonna probably be to be able to get a good growth rate after this normalization happens, and kind of get to a reasonable area where what rate are we going to grow over the next 5 years? All right, so here we can see their net income, operating income, revenue, pretty flat, and then got into a really nice growth period from about 2019 on. That carried on very strongly through COVID, and it's hard to say if we're going to have like a pullback and then a resumption of that growth. If that happens, then it's going to be very, very, very good. If this is a one-time thing and we revert back down to previous income ranges, then yeah, we could have a decent ways to go down. We do see that they have been buying back a decent amount of shares over the last 10 years, probably starting in about 2016 is when they really ramped up those share buybacks. And going on over the balance sheet, we can see this amount of long-term debt growth over the last let's say 2019. So this probably ramped up along with their earnings. So it looks like it's probably correlated to expansion efforts. Short-term cash, what is that, 1.3 billion, and debt right now is about 18 billion. Most of that's probably going to be inventory, possibly property as well. Going over the free cash flow, operating cash flow growth on a per share metric basis, everything is looking like pretty decent as far as the growth that they've seen. If we go over the income statement again, we can see the EPS diluted growth from 2014 on. So we had a nice ramp, obviously, into 2022, huge pullback. So if you're playing target, I think the thesis almost has to be that we're going through a short normalization cycle. They're going to resume their previous growth trends that we're seeing from about 2019 to 2022, and they're going to maintain a decent amount of growth, similarly to what we saw during that period. They have been increasing their dividend payouts. Looks like they increased it pretty drastically in 2021 and 2022. Current payout ratio is sitting right at about 50%, so it is kind of high. Typically, I'd like to see that probably below 50, but they are returning capital to shareholders in the form of dividends, and they are also repurchasing stock. Then on a yearly basis, we can see the per share growth over the last, 10 years, kind of peaking in 2021 and then going down and down and down some more into 2023. Additionally, when we look at their free cash flow, we can see that they have been returning capital to shareholders, like I said, in the forms of dividends. They're doing some debt repayment, and then they are doing a decent amount of common stock repurchases. Looks like that ended about a year ago or so. All right, so for the valuation, I'm going to target a 10% base CAGR with 2.5% margin of safety, which is 12.5%, because we are getting a pretty decent dividend from Target. So the dividend yield is about 3.4%. So combined, we're looking at about 15.5, 16% Target CAGR. And if we go down to their yield metrics, we can kind of see they've kind of hovered in that around, 10 to 5% range. They're pretty low right now. That's basically just from the normalization of the earnings and having a really pretty bad year. The question is that going to normalize? And we can see that revenue is growing at pretty much around 8% tick. So if we can assume that margins will normalize, they'll get their inventory control issues under control, they'll address the shrink and eventually bring their margins back up where we've seen them before. Previously, margins, let's see, they were probably right around 4, 5, 6%, and we're getting back there. They got a little bit more to go, but if they can kind of bring these margins back up to where they were previously and maintain about 8% revenue growth, we could kind of see a nice recovery in the bottom line metrics. All right, so getting on into the valuation, what I have is a target rate of 10% with a 2.5% margin of safety, so 12.5% target just on the equity, and then we have a 3.4% dividend. So that's going to turn out to be about 16% target yield. The dilution, we actually have buybacks in the range of 1.52 or 1.52% to 3.571% bottom line growth. Now, what I did is I normalized the bottom line over the last 3 years for our starting values, and then we're basically looking at bottom line growth equal to about the revenue for the best case scenario, the revenue growth for the last 5 years. So we're kind of assuming that their margins are going to revert to kind of a normalized state. And then they're going to continue to grow at that previous, 7.6 or 8% rate in the bullish case, all the way down to a 4.73% growth rate in the very bearish case. Now, EBIT yield spread, we've got 5.71 in the very bearish case to 2.75. Net yield spread, we have 6.02 to 2.9. Free cash flow yield spread, we have 4.67 to 2.25. That gives the average yield spread across those three metrics, or the average yield across those three metrics, from 9.93 to 4.94 for our basically ending multiple. And that kind of aligns with what we've seen in the past, kind of between that 5 to 10% range. So the kind of case for this, now what that will look like as far as their normalization of revenue and the growth that we're projecting off of that in the base case, is we would end with about 8 billion in EBIT, 6.3 billion in net income, and 5.1 billion in free cash flow by the end of year 5. That's kind of the target. Now we can see that that's actually lower than pretty much their previous peak. So we're not even assuming that they're going to get to their previous profitability. We're basically assuming that they're going to get just below their previous profitability in the base case. In the bullish case, I think that would be about up to the previous highs. So I think it is kind of a reasonable base case that we could kind of trend back towards potentially the previous highs of their bottom line profit numbers. All right, and with those assumptions, we have a very bearish buy price of 80, a bearish buy price of 100, a base case of 126, a bullish of 162, and a very bullish of 210. And I do think those assumptions are pretty, I don't know, I think they're pretty conservative. You're really playing essentially the strengthening of the consumer, the increase in discretionary spend, and Target's ability to kind of get their inventory situation under control and get back to historical margin rates. So the fair value based on that, now current is going to be really low because we're going off of really, really bad last 12 months. And because we're normalizing it, assuming the normalization happens, then your fair value right now, or your 1 year fair value, is between probably 111 to 161, 111 in the very bearish scenario to 161 in the base case scenario. Now for the 5-year targets, for the very bearish 5-year target under these assumptions, we would get about $142, which is pretty much where it's at right now. So you'd get a dividend and maybe a little bit of appreciation. Now the bearish 5-year target would be 178, the base case would be 225, the bullish case would be 288. And the very bullish would be 374. And this doesn't even assume we get back to previous all-time highs on bottom line and grow from there. It's pretty much just a recovery. So I think this is something that would be very potentially possible in the case where we get a recovering consumer and maybe the current news stuff doesn't hurt them as bad as, maybe people think they will, but yeah, we'll see. So with all that being said, yeah, Target is starting to look interesting. I think it really depends on your beliefs around what they are going to do long term. Are they going to be just like another retailer that goes bust, or are they going to actually be able to recover, and are they going to have like a steady consumer going forward? We're getting into interesting levels. I mean, 126, not too shabby. If we can get down to that 100 area, I think that's where it gets really interesting, because around 100, even if you're increasing your target rate to about 15%, so 17.5%, 100 would get you basically into the base case for almost a 17.5% CAGR with a 3.4% dividend yield. So, which the dividend yield will grow if the price went down, right? So might be a 4% dividend yield out of that. So yeah, that's what I got. Target is getting interesting, as are a lot of other retailers. Let me know what you guys think in the comments. Are there any other retailers that you're looking into? And yeah, have a good day. We'll catch you later.